In this episode, we're going to look at how to invest during a tariff trade war. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In today's episode, we're going to cover the following 4 topics. First, we're going to look at what are tariffs, and then we'll take a look at a brief history of tariff wars from the past, and then take a look at what was the stock market reaction every time those tariffs were announced. And then finally, topic number 4 is to look at how should you be investing today in the current trade war that's going on around us. Now, before we begin, just a quick reminder, our approach to investing is to help you build a resilient portfolio that provides you with growing income each year, regardless of market conditions. So the key words here are resilient and growing income each year. So our perspective is a long-term perspective, and that is what we do in all of our episodes and all of our training. We always have a long-term perspective on helping you to grow your income. So let's get started with topic number 1. What are tariffs? Tariffs are taxes charged on goods imported from other countries, and they're paid by the importing business to its home country's government. But ultimately, who pays the higher costs? So let's take a look at this example. So on one side, we've got a Canadian company that is supplying raw materials to a factory in the US. And the factory in the US is then taking those raw materials, producing goods that are sold to US customers. Now, if the US, for example, as was announced recently, was to impose a 25% tariff on any goods coming in from Canada, well, those raw materials are now going to cost 25% more. And then what will happen is the factory will pass on those higher costs to the consumer. And retaliation makes this worse. And we're seeing that play out right now. As of this recording in February 2025, the US has already announced 25% tariffs on Canada and Mexico. And Canada has retaliated by announcing 25% tariffs on US goods. And Mexico has done the same thing, and they've announced 25% tariffs on US goods. At the end of the day, this is a lose-lose situation for everyone involved. So as an investor, how do we invest? Do we stay on the sidelines? Do we invest? Do we wait for things to happen? What do we do? So in order to answer that question, we should first take a look at a brief history of tariff wars in the past, because this isn't the first time this is happening. We've had trade wars in the past. We've had countries, announce tariffs on both sides. And so this has happened in the past. Let's take a look at the history, and then we'll take a look at how the stock market reacted when those tariffs were put in place. So in 1929, the Great Depression had started. And in June of 1930, President Hoover signed the Smoot-Hawley Act into law. And what that act did was to impose a 25% tariff on all agricultural and industrial goods coming in to the US. And then several countries, including Canada, France, Spain, imposed retaliatory tariffs on US products. And then in 1962-63, there was a trade dispute between the poultry producers in the US and the European Economic Community. And so the EEC, imposed a tariff of 13 cents per pound on all chicken coming in from the US. And in response, President Johnson imposed a 25% tariff on light trucks coming into the US. And believe it or not, that tariff is still in place today. And then in 1982, there was a US and Canada lumber war. This led to several rounds of tariffs and retaliatory tariffs, and Canadian lumber still faces to this day a 14% tariff on all of its lumber coming into the US. And then in 1993, the EU placed a tariff on bananas from all Latin American countries. In retaliation, the US imposed a 100% tariff on certain European products. And this was because the majority of the companies that were producing bananas in Latin America were US-based companies. And then in 2012, the EU finally signed an agreement with those countries to end its case with the World Trade Organization. And then in 2002, President George W. Bush placed an 8% to 30% tariff on foreign steel. Mexico and Canada were exempt, but then Europe announced retaliatory tariffs on US products. But days before that was going to come into effect, President Bush lifted the tariff on steel in 2003. And then in 2018, President Donald Trump imposed tariffs on solar panels and washing machines, another 25% tariff on over 800 Chinese products. China responded with 25% tariffs on 128 US products. And then also in 2018, President Trump imposed a 25% tariff on steel and 10% on aluminum coming in from Canada, Mexico, and EU countries. Canada retaliated with 25% and 10% tariffs on a range of US products. And then in 2022, President Joe Biden extended the tariffs on solar panels, but the tariff in 2023 on washing machines had finally expired. And finally, we're here today in 2025. The US has announced 25% tariffs on Canada and Mexico. And as I mentioned before, Canada and Mexico have both announced 25% tariffs on US products. So you can see here on the screen, this has been going on for a very long time, starting in 1930, even before that, but I just decided to start there in 1930, 1962, in 63, 1982, 93, 2002, 2018, 2022, and then 2025. So this has happened many times in the past. And what was the stock market reaction back then? So we're going to take a quick look at the history of the stock market's response to those tariffs. So if we take a look at this graph up on the screen right now, this graph only goes back to 1970. I'm going to show you a couple of other ones that go further back. But from 1970 to 2025, you can see that overall, the stock market has done very well, and it continues to go up. There are periods in time where you can see the market drops, and that's happened quite a few times. You can see that up on the graph, but the overall trend has been positive. So that's something to keep in mind. Now, what we do is if we overlay on top of this graph some of the tariffs that I talked about, so in 1982, in 93, 2002, 2018, and 2022, you can see that even at those periods in time, in some places the market dropped, but then the market came right up again. So again, overall, the trend is positive, and the graph is doing this. It's starting here, and it's going up, 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 and up over the long term. And in this case, we're looking at a 55-year period. Now, if we go further back, this goes back to 1871 up until 2024. Now, this graph is a little misleading just because of the scale and to get it to fit on the screen. If you look at from 1871 to 1984, it looks like the market didn't do anything because it just looks like a straight line, but it did. In fact, the market had continued to go up even from 1871 to 1984. The market continued to go up, and then, of course, you can see the rest of the graph, the market continued to go up again. So what I'm trying to say here is that the overall trend since 1871 has been, over the long term, has been a positive rising trend. So here's another graph. This one goes back to 1872 up until 2024. And again, you can see that the market goes up and down. And the red line represents when the market is down, and the green line represents when the market is up. So the good news is there's more green lines on the screen than there are red lines. Okay, so you can see that the market overall has been positive. So again, here we're going to overlay all of the tariffs we talked about, starting from 1930 all the way up until 2022. You can see all these tariffs were announced, but yet the market continued to go up. The important number on this screen here is going to be the overall average. Since 1872, the market has returned on average 8.6%. So that's a positive number, so that's good news. And it's showing us that the stock market has been resilient, and overall it has continued to rise. So then how should you be investing now? As an investor, what do you do? So number one, avoid panicking. Remain calm, that's number two. And number three is remain disciplined. So you want to avoid any knee-jerk reaction, especially when tariffs are announced. We can immediately see that the market drops the same day or the following day. So you want to avoid panicking and selling anything that you own, because the worst time to sell is when the market is down, because that's when you solidify your losses. So avoid any knee-jerk reactions. You want to remain calm and give it some time and see where the market is going to settle at. And then you want to remain disciplined. I'm going to talk about our approach to investing in a little bit more detail. You want to stay disciplined and stick to the approach. I've been doing this for over 25 years now as a dividend investor. You want to remain disciplined throughout all of these ups and downs. The other thing is you want to focus on recession-proof companies, because those are the companies that are providing products and services that people will need all the time. Think about food, think about electricity, heating oil, insurance, mortgages, financial services. These are things that people will need. Even if you were to get laid off from your job, you would still have to, pay for food, pay for clothing, pay for utilities and everything like that, pay for shelter. So the recession-proof companies, regardless of what the market does, will still be around. They will still produce product and services that people need. Look for companies that have a history of profitability. So let's take a quick look here at Canadian National Railway. We're looking at a 26-year chart of earnings per share. That's EPS. Earnings is how much money the company is making. So if we look at the last 26 years, you can see that overall, in the long term, the company has been profitable. Now, there's a couple of years where the earnings have dipped, and you can see that on the graph. There's a couple of points where the earnings go down, but overall, it's up. The overall graph is doing this, and it's going up. So that's important to us. And the other thing is you can see that the earnings have never been negative, right? There are companies out there that have negative earnings sometimes. And in the case of Canadian National Railway, even though the earnings have dropped in some years, they have never gone into the negative territory. So this is good news. And so this is what we want to look for when we're looking for companies that have a history of profitability. And we want to look at 10, 15, 20, 25-year history and see, has the company been profitable? And why do we do this? Well, the reason for this is because nobody can predict the future. I don't know if CN Rail, Canadian National Railway, is going to make more money next year or less money next year. Are the earnings going to go up or are they going to go down? I don't know. But when I can see this graph and I can see a track record, a 26-year track record of growing profitability, I can have a high degree of confidence that this company next year will have a positive earnings number. It may go up or it may go a little down, but in the long term, the company should be profitable. Next, we want to look for a company that has a history of dividend increases. Because remember, the dividend is what you are getting back as part of the profits that the company is making as a shareholder. And I've said this before in other videos. If a company is paying a dividend of $1 per share and you own 1,000 shares, you will receive $1,000 every year for as long as the company continues to pay the dividend and as long as you continue to own those shares. So the dividend, that's cash in your pocket, gets deposited automatically into your trading account. And you can spend that money if you wish, or you can reinvest it. So because of this, we want to look for a company that has a history of not only paying a dividend, but growing a dividend over time. So let's take a look at this example of Procter & Gamble. You can see on the graph on the screen, this is a 26-year history of dividend increases, and you can see that the dividend has gone up every single year. Unlike the earnings, where we had 1 or 2 years where it had dropped, the dividend has never decreased for this company. In fact, this company has had 68 years of consecutive dividend increases. Think about how many market crashes we've had in the last 68 years, how many recessions we've had in the last 68 years, how many times tariffs have been introduced in the last 68 years. But this company, and there's others like it, have continued to grow their dividend year after year after year. Now again, nobody can predict the future, but when I look at this graph, I can have a high degree of confidence that this company will continue to pay me a dividend in the future and hopefully increase that dividend every year. And then the last thing is we want to make sure that we're only investing in companies when the stock is priced low, when it's undervalued. Stock prices go up and down all the time. And the worst time to buy is when the stock price is high, when it's overvalued. You've all heard the phrase buy low and sell high. Well, it's important to buy low. You're going to be able to buy more shares for the same amount of investment you're putting into the company. And the more shares you have, the more money you're going to make in dividends. So that's very important. How do you know when you're looking at a stock if it's priced low or priced high? Well, for that, it's easy. We take a look at the current dividend yield. If it's greater than the company's 20-year average dividend yield, then the company is considered to be undervalued or priced low. So for more information on that and more details and more examples on how we figure that out, I've dedicated an entire episode to looking at undervalue and overvalue. And so I highly recommend you go back if you haven't seen it, take a look at episode number 1, and we go through a lot more details in there. So remember, avoid panicking, remain calm, remain disciplined. And then we talked about these 4 things to look out for. Focus on companies that are recession proof, look for a history of profitability, look for a history of dividend increases, and only invest when a stock is priced low. So how do you know when you're looking at companies that they follow all of these things? What we're looking at on the screen are what I refer to as quality criteria, right? So we want to invest in quality dividend paying stocks when they are priced low. So not just at any price, they got to be priced low, and not just any stock that pays a dividend, but it has to be a high quality stock. So how do you know when you're looking at a stock anywhere in the world? How do you know when you're looking at a stock if it's a quality stock and if it's priced low? So for that, I've created what I call the 12 rules of simply investing. You can see the 12 rules of simply investing up on the screen right now, and I'm going to go through them fairly quickly. This is just a quick introduction, but what these rules are designed is that they're designed to help you lower your risk and maximize your gains. So you want to make sure that when you're looking at a company to invest in, that you apply all of the 12 rules. If a company fails even one rule, skip it. Move on to something else. So a company has to pass all of the 12 rules up on the screen here. Rule number 1, do you understand how the company is making money? If you don't, skip it. Move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession proof? And we talked about that in today's episode. Rule number 5, is it profitable? So we also talked about that, looking at the company's 20-year history of profitability. Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, we want to avoid any company that has had a recent dividend cut. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? Rule number 12, keep your emotions out of investing. So what we've created here at Simply Investing is an all-in-one solution. It covers the Simply Investing dividend course and the Simply Investing web application. This is going to be your easiest way to be able to apply those 12 rules to any stock anywhere in the world. The Simply Investing course is broken up into 10 modules. In Module 1, we cover the investing basics. Module 2, we cover the 12 rules of Simply Investing in detail with real-life examples. Module 3, you learn how to apply the 12 rules. Module 4, you're going to learn how to use the Simply Investing web application. Module 5, placing your first stock order step by step. Module 6, I'm going to show you how to build and track your portfolio. Module 7, you're going to learn when to sell, which is just as important as to know when to buy. Module 8, reducing your fees and risk, especially if you own mutual funds, index funds, and ETFs. Module 9, your action plan for getting started right away. And Module 10, we answer your most frequently asked questions. And the Simply Investing application looks like this. What it does is it takes the quality criteria that we looked at today and it applies that to all over 6,000 stocks in Canada and the US every single day. And it'll display for you immediately which stocks are quality stocks, which ones are undervalued, and it'll also show you the ones that are overvalued and priced high, so they should be avoided for now. And the application will also help you plan, track, and achieve your investing goals. So this is the all-in-one solution. It includes the course and the web application. If you're interested, you may want to write this down. We have a special coupon code for all of our viewers, SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution. If you enjoyed today's video, be sure to hit the subscribe button, hit the like button as well, and for more information, take a look at our website, simplyinvesting.com. Thanks for watching.